How to Own the World by Andrew Craig. What is wealth? Wealth is the ability to live on the money you make from investments, rather than the money you make through selling your time for money through the form of work. Craig suggests that the reason so few people become wealthy is because they rarely spend time to educate themselves properly and learn and apply themselves to investing. If you do not have a solid grasp of what is going on in the world, then you are likely becoming poorer. The good news is that it's never been easier to make the most of your money and turn that situation around. Fundamental changes in economics and technology have altered the playing field. Those equipped with the knowledge to capitalize on these changes can invest over the long run to grow their wealth and reach a point where their money pays them more than their salary. Inflation is the enemy of us all. Many people think investing in the stock market is risky and instead prefer the safety of money in the bank. But when considering how safe your money on deposit at a bank or building society actually is, you must understand the difference between the interest rate your bank is paying you, the nominal rate, and the interest rate your money is actually earning, the real rate. The difference is inflation. Any money you have is gradually being eroded in terms of purchasing power. If you have any savings in the bank, you are losing real wealth every day, and losing more than you think. This is one of the many reasons people are feeling poorer without really understanding why. If your money in the bank is earning 5% when inflation is running at around 10%, then you are losing around 5% of your wealth every year in real terms. It is important for your long-term financial success to keep as much of your wealth as possible in assets that have a positive real return. Craig has a skeptical view when it comes to how governments report statistics and believes that government-reported inflation figures are distorted by using the following methods. Substitution, e.g. changing one product for another where inflation may be lower. Geometric weighting, e.g. changing the weighting of products in the calculation. For example, getting the new iPhone may still cost £1,000, but it counts as £800 since you're getting more for the same money each year in a newer technology product. Hedonic adjustment, reducing a price in the calculation according to the perceived utility of the product. Shrinkflation, where products get reduced in size but treated the same way in the calculation. We've all opened a packet of crisps at some point in our lives and realised that the packet now seems to be mostly full of air. The result is that these figures contribute to a grossly underestimated perspective on inflation. This is masking the impact of significant tranches of quantitative easing. The retirement problem. If you want to have a pension income equivalent to the average British salary of roughly £27,000 per year, you'll need to have saved up a pension pot of around £675,000, rather than the £30,000 which is currently the UK average pension pot. Poor state pension provision. Major governments have been growing a debt toll and simply won't be able to fund the state pensions in the future. To support borrowing, governments are turning to QE, which in turn creates inflation. Own the world, own inflation. Before investing, we need a financial surplus. We need to carefully budget, and we need to optimise our current account and pension arrangements. To take advantage of global economic growth and to counter the effects of significant real inflation, we must create investment portfolios that aim to own the world and own inflation. Craig suggests owning a diversified investment portfolio of multiple asset classes such as cash, shares, bonds, commodities and property, spread around the world in different geographical locations. Shares. Why investing in shares works. The world economy keeps on growing. Driven by the rise of the developing world, access to resources and overall competitiveness, the world economy has grown remarkably over the last few decades. This is the principal reason why Craig advocates owning the world. It's also why the top 1% in developed countries have grown so much in wealth, by capitalising on growth in the developing world. Real estate. Craig points to the property market as one of the key risk areas to this financial surplus, arguing that most individuals in the UK and the US are overexposed to property. He suggests a property should never burden us with more than a third of our monthly income in costs. If the only investment you have in life is property, then you are missing out on substantial opportunities to grow your money, and your financial situation is fundamentally unbalanced. Property investment should be carefully evaluated for its long-term potential, considering the related costs, trends in rental yield, value to salaries and interest rates. Property generates a great deal more work than nearly all other investments. Precious metals. Where this book differs to a lot of books I have read is the author's approach to including commodities within a portfolio. To own inflation, we will likely need more exposure to commodities. Craig recommends gold and silver, principally because they have been used as a money alternative to fiat currencies. Gold prices go hand in hand with inflation. Also, gold's supply is fixed, with minor additions every year. Silver is also mentioned as an alternative to gold, since it has a higher industrial use and it can supplement a precious metals portfolio percentage. Own your life. No one is better placed than you to make the most of your money. Making money from your money, investing, is far easier than you've always thought. If you manage to learn how to drive or open a bank account, which I imagine is most of the viewers watching this video, then you can look after your own money. It is no harder. You can make far more from your money than you ever thought possible. It is realistic for you to target making more from your money than your job. This is the money secret understood by virtually every rich person in history. If you are under the age of about 50, there is little chance that you will receive a government-funded pension you can actually live off in retirement. If you are younger than this, it's even more important to build your own retirement pot, as this state provision may or may not be there in the same capacity in years to come. One of the fundamental truths of capitalism is that capital makes a great deal more money than labour. People who own businesses tend to make far more money than people who work for them. Don't borrow too much money or stretch yourself too much on your house. Live on less than you earn and invest the rest. Invest globally in a diversified low-cost portfolio for the long term. Do this consistently month in and month out, and you too will be well on the way to owning the world and creating financial freedom.